NVIDIA shed $600 billion in market cap today on news about DeepSeek from China. And Tesla's going to be reporting earnings on Wednesday. And we're going to talk about that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, where we talk about, well, today we're probably going to talk a little bit about NVIDIA and on DeepSeek as well. But I had actually originally planned us to talk about Tesla earnings, which they're going to be reporting on Wednesday after the close. So let's get to that one first. Elon Musk generally leads the company's earnings calls. However, this is going to be the first one since he was appointed to the head of the Department of Government Efficiency in President Donald Trump's administration. And, well, business leaders have held advisory roles or influenced policy externally, assuming a formal position within the executive branch while running several large companies is, as far as I know, unprecedented. So the government can certainly benefit from leveraging Elon's business experience to try to shape economic policy and streamline government operations. After all, he did buy Twitter and he laid off something like 80% of the staff. And the experience, now that it is X, is largely the same as it was prior. What is less clear is whether Tesla shareholders are going to benefit from him dedicating a significant amount of time to DC. So according to the New York Times, he's going to have actually an office at the Eisenhower Executive Office Building, which is adjacent to the West Wing. My understanding is that he had hoped to actually have an office within the West Wing. In any case, presumably more influence is better than less, and Elon has the president's ear at the moment. So this should be a positive for the companies that he controls that have government contracts on balance, one would assume. However, one of the things that we certainly have also seen is that President Trump does not favor all of the government policies that support Tesla. He has already reversed directives that encourage the adoption of electric vehicles. So, at the moment at least, the bull case for Tesla hinges primarily on three drivers. The first is, of course, EV sales. The company can beat expectations on vehicle sales. They announced and have been showing around the redesigned Model Y, which seems to have several significant changes. The Cybertruck is supposedly beginning to sell more profitably, at least. And this is notable because Tesla is the only U.S. automaker that is selling EVs profitably at the moment, and they're outselling all of the other EV competitors combined. Regardless of whether or not the Trump administration is as supportive of EV sales as the prior administration was, the total addressable market for EVs is growing. That part seems to be inevitable. And the margins that the company has are better than anybody else's in it, and they have the dominant market position. The other thing I would say, and I think this is kind of important, is that Tesla is also a technology business. Obviously, they've got the full self-driving, robotics, and so on. One of the things I wanted to show here very quickly, so we're just going to take a look at their income statement as they report it. Oh, actually, is it? Or maybe this is within the segment section. I was looking at this. I'm trying to remember where I was seeing it. Oh, here we are. Yeah, this is the part that I wanted to make sure I was able to show you. So the lines that you're going to be interested in, and maybe I can even blow this up a little bit if I can remember how to do that. Or is it this one? Can make this a little bit larger. And let me see if I can also highlight this. So this is the area that I think is interesting. Energy generation and storage. So the energy generation and storage portion of their business is growing more quickly than automotive revenue. So I think that's kind of an important thing to pay attention to, and is one of the basically metrics that I think is going to be interesting for investors when they report on Wednesday, is keeping track of that bit right there. This is a portion of their business that they have that their competitors don't really possess at all. So I think that's clearly going to be important. Full self-driving, GM's Cruise is getting folded into GM proper, and it's not clear that they're going to have technology that will be as scalable from a cost perspective to be sold into others. So I think that's going to be kind of important. So full self-driving, the data that they have is probably better than what anybody else has, including Waymo. I have previously said that I rather like the idea that Waymo and Cruise were using multi-sensors in their full self-driving technology. But one of the benefits that we can certainly argue is true for Tesla is that theirs is a much less expensive approach. And then, of course, the other real benefit that Tesla has is Elon himself. They're kind of inextricable. They're kind of peerless, it should be said. The issue that I have, though, is what valuation do we assign to this exceptionalism? Now, with respect to Elon, I want to just talk about valuation because he has said relatively recently that he thinks Tesla could become the most valuable company on the planet. Maybe. It gets a lot easier to get to that level when some of the other largest companies on the planet have massive pullbacks, as NVIDIA did today. $600 billion in market cap coming off of the top certainly makes Tesla a little bit closer. So obviously Tesla lost a couple percentage points today as well. But the real question we have to ask ourselves is, does it make sense that Tesla, as it currently stands, is worth double the combination of General Motors, Ford, Toyota, Stellantis, Volkswagen, Mercedes-Benz, and BYD? That's the Chinese Beyond Your Dreams EV and battery maker combined. Because that's where we're at right now. Or thereabouts. Now, I didn't actually do that same math today as of the decline that we've seen in several stocks because Tesla has declined a little bit more. But that's about where we were as of Friday's close. So Tesla was worth double GM, Ford, Toyota, Stellantis, Volkswagen, Mercedes-Benz, and BYD combined. And as I think about that, I've said many times I am a fan of Elon Musk, a big fan, it should be said. I'm a big fan of Tesla, the company, and their products. But wow, that valuation is really a little bit of a challenge for me. So what is interesting is that when I was looking at this over the weekend, the implied move for Tesla on earnings, which they're going to be reporting, was less than 8%. And the reason that was so notable to me was take a look over here. Once again, I'm just going to try to blow this up a little bit so we can get a good peek. These are the numbers I want you to look at over here where it says price change, where my cursor is right now. I can put that little box in here too if that's helpful. So what I want everybody looking at is, if I can find where my cursor went, is, whoops. Is right in here. Okay, so that's the area that you want to pay attention to. And basically the deal is that the smallest one-day move that Tesla has seen, higher or lower, following earnings over the course of the last 8 reported quarters, was this one right here when they did their Q3 23 earnings back in October of 2023. So about, not quite a year and a half ago. That was a 9.3% decline. Every other earnings-related move out of the last 8 quarters was larger than that. You have to go back to April, to get a smaller number. But you can see 22%, down 12, up 12, down 12, 9, and so on. So we've gotten some really big moves in here. And yet it's implying less than 8% move. So from my perspective, if you happen to own these shares, I think it makes some sense to contemplate hedging that, frankly, to the downside with something really short dated. Just try to capture the move. And I actually was writing about this over the course of the weekend, so if anybody happens to subscribe to the Options Edge, I wrote about it there. or if you are subscribers to CNBC Pro. I think the CNBC Pro article actually got up a little bit later, but I was writing about these same issues in there as well. But if you have something that typically moves 9, 10, 11% on earnings, you can essentially buy options that are implying a move of about 7. And then you combine that with what we saw today, which is that very clearly investors are a little bit anxious about valuations and about the promise of some of these technologies. I think today's... oh, I didn't mean to be on SPY. Thank you for bringing that to my attention. I was about to put this in, and actually I would have noticed that as soon as I saw the share price, because of course this is closer to $400. So I'm just going to put this in. And yeah, I think I was actually advocating when I was looking at this over the weekend. I was thinking about something like a 400, 370, 360, something like that. The stock is now lower, of course, because it fell almost $10 today. So you could actually step that down just a little bit, maybe by something like a 395. And what we're looking at is what is how much has it moved in the past versus what it's moving right now. So try to take a look at something that's within that range. So it's implying 7.5%. It has historically moved over the last 8 quarters, something in like a 10 to 12 range. So 10% from this would be down $40. That's going to get us down to about 355. And you could look at something like that as, I think, a decent way to sort of hedge your downside, if you will. And that's going to be like this, right? So spending $12.85 for a $40 wide put spread. It's pretty close to at the money. And if you get a move lower, you have probably a pretty decent hedge. Now, of course, the stock's already down 2.3% today, but this is really more about concerns about their operating performance than it is anything that has to do with DeepSeek and some of the action that we saw today. I think that there's just a lot of sort of carry-on concern that is affecting other high-flying stocks. And Tesla, by the way, for what it's worth, has already had a not insignificant pullback from its all-time highs. And actually, by the way, I happen to be looking at some other things, including the equal weight. So reasons to be in the equal weight. I think today we got a good example, the R in the rising acronym. Here's the equal weight S&P 500, closes up 16 basis points versus SPY, which is down 140. Not, that's actually significantly better than it was on the lows, but... So what's also interesting is that at one point today, the equal weight S&P was also down, even though 65% of the stocks in the S&P 500, this will probably surprise some of you who haven't looked at it, 65% of the stocks in the S&P were actually higher today. The issue is that it was the really big stocks that were down sharply, and it's how much they were down that ended up carrying the cap-weighted index so much lower. But most stocks, 2/3 of stocks, were actually higher today. Kind of hard to believe, but yeah, that's the fact. So yeah, that's my thinking for that. And there's two things I also should mention as well, and one of those is that I'm going to be on Fast Money at 5 o'clock. Eastern, which is coming up. So this is going to be fairly short today. And because of that, I am going to try to take a look at some of your questions straight away and get through those very quickly. So Rajana Gupta, today I sold a Feb 1444 cash secured put on CCJ for $50. What do you think of the industry and my trade? Like it? I like the industry. So for people who don't know, Cameco is in the uranium space. So this is one name that you could trade. And actually, I put out a bullish trade on Cameco and also URA, which is the ETF that tracks uranium underliers as well. I'm trying to remember when that was. Obviously, I don't know what you guys are going to ask me about ahead of time until you actually do. So I probably would be able to go back and look at that a little bit more closely. But I do like the space. And so this is an interesting one. The other thing is, I mean, take a look at the valuations where you're doing this. Seems like this is a pretty reasonable area to start getting in here, especially. So this was the. Oh, oops, I'm on uranium here. But the same thing applies, for what it's worth. So you were looking at the 44 strike, and oh yeah, that's right back in here. So that's actually well below the 200, which is where we're bouncing around right now. But yeah, this is the kind of time to think about this, right? Start thinking about things that you want to own, wish you had owned from lower levels, and cash secured puts, not a bad way to play this, because one of the things that's going to start happening here is that you're going to see that as people are getting a little bit panicked, implied volatility will rise in response to that. Bear in mind that one of the other reasons it's going to look higher is also just because the stocks are going down, and because of skewness, that is the fact that those downside strikes are trading at higher implied volatilities than the at-the-money options are, that one of the things you're going to end up finding is that you're getting a bigger percentage of the current stock price, a bigger percentage of the strike you're selling to do that. But in response to your question, Ranjana, I like that trade. I like the space. I like the trade. I like the way you're thinking. Bob, both down 17% today. Would you rather NVIDIA or Broadcom, or would you rather Taiwan Semi? Did I share that? Just making sure. So, this is an interesting thing here. One of the questions we have to ask ourselves is, did DeepSeek really achieve something that is within the same order of magnitude as other AI businesses have, with a tiny fraction of the investment? I mean, is such a thing possible? In other words, is their approach so much better? Or is DeepSeek, for lack of a better word, a deep fake? I'm not saying that it is. But I think that any investor should approach this with a little bit of skepticism. It's a pretty profound achievement if what they're saying is right. But one of the things I said on the most recent live stream on Friday with Mark Guthner, and that was actually during trading hours. One of the things I said about NVIDIA is that whether or not DeepSeek is real or not, I'd rather you think about something else, which is that this number right here is just a really difficult one to preserve for the long term. What number am I pointing to? This gross margin. 75% gross margins, 56% net income margins after taxes, growing at these kinds of rates. They have the biggest target on their back. So it doesn't really matter to me whether DeepSeek is going to be the answer or not. I just think that we have to assume that this is going to normalize and mature at some point. That said, I still believe that their products are best of breed. And, we're really, the question is not can they continue to grow at the same rate that they have done over the last several years. I don't think that's achievable. Or that their margins are going to stay the same as they are right now, because I don't think that's achievable either. It just doesn't fit the pattern of technology and technological development for that kind of thing to persist over the long term. But I will say that if we can assume that margins compress and that their full year 2026 numbers remain intact, does that make some sense. And then they then grow, basically they grow, the top line margins come in, and can they make $5 a share, for the next several years, something like that. That doesn't seem so unreasonable to me. Taiwan Semi obviously has another, they have said they were going to build onshore. I think Trump is making it clear that he wants that to happen. It feels like some of the CHIPS Act money has sort of found its way towards Taiwan Semi. So, I kind of feel like you probably are not going to be that bad off if you decided to try to take advantage of this big, sharp pullback and just get broader exposure to the space. You could do that either through the SOX index or one of its proxies, buy a little of each of these, take advantage of the elevated premium, that sort of thing. So Taiwan Semi now, let me just put this into, I'm going to, because this is not in US dollars, I'm going to do that really quickly. Put it into US dollars per share because that's what your ADR is going to be in. So, it's kind of interesting when you look at it this way. NVIDIA, to me, is arguably a better deal. Trades at a more attractive multiple, especially now, net of this huge, sharp pullback. And the other thing is, let's just take a quick peek here at implied vol. So now we've gotten implied volatility, that's the white line, is up to 54%. So if you, for example, sold something going out a couple of months, and the amazing thing is, everyone's sort of thinking about things like earnings, and then you have something else come in from left field. But, take a look at this. So, the 115s, for example, the March 115s, which are 53 days away, you could get over $9 for those puts. So worst case, you have the stock put to you at 115, net $9 and change. We'll just call it 9 for the sake of argument. So you're going to own the stock at $106 a share. And otherwise, you're getting, a standstill rate of return of 7.8%. Doesn't seem like a bad trade. Yeah. So that would be certainly something that I think is reasonable. But like I said, I think the whole space, you might want to take advantage of the fact that you had this big sharp pullback, and you get a big bump up in implied volatility. So kind of like Ranjana was talking about, you have the stocks at a discount and you have options at a big sharp premium, and the combination of both of those at the very least is going to improve your probability of success. You're going to own these things at a much better valuation than you otherwise would have. So I like these trades in general. Right here and now. And part of that, so just take this for whatever it's worth, part of that opportunity stems from some of my skepticism about DeepSeek. I'm not saying it's a phony, but it's interesting timing, right? We've got Chinese New Year here. We have previously talked about the challenges that China faces. They could use a win. You've got saber rattling on the tariff front, and you put all those things together, and there's a little bit of copycat action that has gone on in China. They haven't always looked at IP the way we would from a legal perspective. So I'm not saying it's phony. I'm just saying put that into your calculus as you think about how to proceed here. I've heard people speculate today that maybe they actually did a lot of the training on NVIDIA GPUs that they somehow acquired through other means. There's a bunch of different things that could be happening here. It could be true. But, is everybody who's investing in this technology suddenly going to say, okay, we're not going to do it? Because supposedly the Chinese, in some ways, it encourages them to continue their efforts. They don't want to be left completely behind. So, anyway, there is that. FinWest, some tech on sale today. Boy, is it ever. Now, look, for what it's worth, I had said that, I said it on CNBC, I said it here, I kind of favor equal weight S&P over S&P cap weight. That still remains true. And part of the reason for that is that, over the course of, and we went through this on an earlier live stream, so I'm not going to do it again, but I will say that the compound annual growth rate on an EPS basis for the equal weight S&P is on par with, and in many cases has exceeded that of cap weight. But the valuations, which have often tracked in history close to one another, have really diverged. So we're talking about a 4 or 5 turn difference in the valuations between cap weight and equal weight. So I still, I still favor equal weight at this time and place, which is RSP. I just wish that RSP didn't have an expense ratio that is, almost 3 times that of SPY, and SPY in turn is 3 times that of VOO, VOO, which is the Vanguard S&P ETF. Which, by the way, henceforth, if you're just buying the ETF, that's the one I would favor over SPY. Just another point. And actually, I think it's about to exceed it in terms of assets under management, because I think I heard something earlier today which said that VOO has not ever had a net redemption month since the outset. So basically what's happening is people are just allocating to it, doing their passive indexing, following the commandments of John Bogle, the founder of Vanguard. And, you can ask yourself, would you rather pay more money to BlackRock or less money to Vanguard? Up to you. And I actually double checked, because it is possible to have, let me just show this real quick, because I think this is kind of important. So it is possible, even if you have the same standardized strategy and you have an index that is replicatable, by 2 different parties, sometimes you will find that one group just does it a little bit better than the other does. So I think it's IVV is another one of these, if I remember. It could be. But the IVV and VOO have lower fees than SPY does. So you're buying a proxy for the S&P 500, but these two charge you less money. And that means that you just get more of your returns. So it makes sense. I have no relationship with the managers of any of these. And I don't have something against BlackRock per se, even though they are the 800-pound gorilla. It's probably bad for me to get in any public setting say anything negative about the world's biggest asset manager. But I will say, all else equal, you'd rather do that. Okay. So, whoops, here. This is Monday Morning Quarterback. Bearish on Tesla, so obviously don't own the stock. Saw your 395, 310 put spread, but better to buy Feb. Okay, so did I put 395, 310? For some reason, I thought I put a 395, 355. $40 put spread, I thought, is the one that I was using. So what's the difference in this case? The reason I was advocating for the weekly, the January 31st weekly, is because I have a very specific target in mind, which is earnings. So if the stock trades lower on the back of earnings, that is intended to serve as a hedge against that event for shareholders. Obviously, if you have a longer-term bearish view on Tesla, that's a different thing. So what are the advantages of the short term versus the long term, and vice versa? Okay? So the advantage to the longer-term one is that if you are just a bearish participant, then you might want to just take a longer-term view because you're expecting the stock to trend lower. The flip side of that is that a vertical spread is only fully monetizable, let's say it runs to the short strike, at expiration, which means that this put spread right here, this weekly one, you're going to know by Friday whether this thing is worth $40, and indeed it was the $395, $355 I used. So this thing could be worth $40 if the stock falls to $355 or lower by Friday. It'll be worthless if the stock remains where it is right now, or it just remains above $395, or somewhere in between. And you're just targeting the catalyst. You're risking, just under $13 a share. So I'm just going to say 13 over 400. So you're going to be risking 3.25% of the current stock price because the things typically move 10, 11, 12% over the course of the last 8 quarters after they've reported. So, you can mitigate a decent amount of your downside risk if you choose to do that. The downside of this is that if you're generally bearish because you think the valuation is too high and you have a feeling that the market's going to roll over. I saw that there was an analyst from Stifel who has like a $5,500 price target for the S&P end of year. So if you happen to have that belief, then you want to use the longer dated trade, because this is more of a coin toss situation targeting just that catalyst, whereas the other one is more of a longer term sentiment trade betting on a trend going lower. And actually, to your point, if you're going to do that, I think it's advisable probably to take a look at a bigger spread as well. So have a lower short strike, because if you're expecting the stock to pull back, are you really trying to commit everything you've got to a bet that the stock's going to fall 10%, or do you have a significant view that something is overvalued? So the longer out you go, sort of the bigger move I would play for. And you might even think about bringing the higher strike down just so that you actually get a better payoff, right? So, here, the 360, 320, let's just say, I'm going to use this as an example. So now you're getting a 3-to-1 payoff if you're right by March expiration. And 320 might seem like a big decline, and it is. It's not, I'm not trying to understate that. I mean, you're talking about a 20% decline or thereabouts if I'm just calling the stock 400 right now. But, this is also a stock that has moved quite significantly in the past. So it has had some big peak to trough drawdowns. And, I want to make another point about this, which is that, there are folks who will try to make a case against Elon or against Tesla, and they'll try to sit there and explain that the reasons that you would make a bet like this is because, the Model S has been around for a very long time, or the Cybertruck has engineering problems, which is not that surprising for a novel product. I mean, this exoskeleton approach, there's a lot of things about some of these products that are very unlike other cars that are being sold. I'm not negative on them. I'm actually generally positive on them. I'm just having a harder time with the valuation. So I believe in Elon. I believe in Tesla. I believe that the issues that they have with their vehicles are going to be resolved. We've owned a couple of them, and I think they stack up very favorably, especially in terms of what you pay for them compared to other vehicles that we've owned at the same or higher price points. I just have a hard time with the valuation, and it feels like the market's a little bit more on edge here. Okay, so Bunny 23, hello Mike. I saw someone bought NVDA Jan 26 expiration 80 calls deep in the money. It is less capital outlay than buying the stock, but what are the pros and cons of buying a call like this? Yeah, it is. Look, that is an approach that one can take that will reduce. Of course, people could margin the stock, right? That's another way you can, get that kind of leverage if that's what you're after. Let me just put that one in. So it was the January 26th, I think you were saying. I probably just went right by it. 25, 20, March. There we are. January 26th. 80 strike calls. And those are $48. So you're basically paying away $10 in extrinsic premium, functionally equivalent to owning the stock and owning an 80 strike put. One of the other things I would say about that, though, is it's interesting. Where do you think the valuation of NVIDIA could go between now and next year? I mean, that's a big. You're getting some insulation, but not that much, right? So are they doing this for leverage, or are they doing it because they want to reduce their risk? If you're doing it to reduce your risk, I would have to say I'm not that crazy about this trade. And the reason is because you're paying $10 over, so effectively you're saving yourself all the pain of any risk below $70 a share, which is a 40% decline from where it is right now. I don't know. I'm not that crazy about that. I'd probably rather a call spread risky or something like that. Buy a longer dated upside call spread, sell a downside put for even, and give myself a buffer closer to spot. Because a 40% decline, I mean, what's the market cap now? We lost $600 billion so far. Oh, and I'm going to have to jump off a little bit early today, as I mentioned, because I've got CNBC coming up. I have a hard stop coming up because I've got to be on the air. Yeah, so a 40% decline from here. We're talking about another $1 trillion. And, the company is going to be, even if it does what it's doing right now, $60 billion a year in net income, which seems reasonable, at least for the near term. And I still anticipate some growth, even net of all of this. I don't know. I think I'd rather be a put seller or do call spread riskies, which is kind of got a similar aspect. All right, guys. Well, I have to apologize to all of you because today's obviously is very short. Wednesdays will be much longer. I'm going to be back here 4:15 then. But unfortunately, because I'm going to be on live television for CNBC, rather than just talking to all of you one-on-one and taking your questions, I'm going to scan these. But just be sure to tune back in again on Wednesday and drop some other questions in, and I will try to answer those, and we'll give it more time and attention. And we're going to get to see another couple days to see how things wash out. Interesting day. It's going to be an interesting week. A lot of more big earnings on tap. So DeepSeek's not the only news we've got. We've got a lot more to talk about, and we will on Wednesday at 4:15. Thanks for watching.